Of all the things that can affect the accounting equation, nothing can tip the scales like payroll. Payroll can represent a significant sum you owe to your employees, and this can greatly impact what you own. As a result, payroll can have a large influence on your assets and liabilities, affecting the accounting equation and ultimately the balance sheet. Payroll is a significant expenditure on the profit and loss statement and can eat away at your net profit. This can turn up on your balance sheet as lower cash, which translates to less assets to pay off your liabilities. Listen to our expert as they explain more about this important balance.
Remember that when we are talking about payroll, we have the amount that is owed to our employees. We also have amounts that are deducted from our employees that are really just passed right through the organization and out to the federal and state governments that have mandated that we do that as employers. There's also deductions that could be coming out that are mandated as well for garnishments or health insurance and other types of benefits that need to be passed along, as well as, of course, just recording the expenses that the employer has to pay versus what the employee is paid and so on. So how does all of that affect the accounting equation? Of course, the income and expenses of an organization are on the profit and loss statement. Of course, you guys know that. When we pay employees, that is an expense. And so, of course, that is on the profit and loss statement. That ultimately, all income and all expenses are ultimately going to close out and go to the equity section eventually at the end of the year. But as I said, there are a lot of payroll deductions that are coming out that are liabilities. They're usually current liabilities because they're going to be paid in the year. So current liabilities are paid within 1 year. So there are going to be payroll liabilities that could be sitting on the books as well. So there could be payroll that is paid out on a monthly basis, or actually it could be paid, depending on the client, it could be paid every single time there's a payroll run. Then there could be some things that are monthly and also quarterly and then annually. So if there are deductions that are taken out, for example, for federal unemployment taxes, that is typically paid annually. So there is going to be money sitting in a current liability account that are going to be paid out at the end of the year. So of course, in order to pay that liability, assets minus liabilities equals owner's equity, right? That is our accounting equation. We need to make sure that we have an asset, cash, sitting in the account for our client that is going to pay out those liabilities at the end of the year. So one of the things that often happens with employers is they think, I need to be paying my employees, let's say it's going to be a $10,000 payroll expense. And when the payroll is actually run, they see that it's not just $10,000, it's also the other employer taxes that need to be withheld and so on. It may be a little bit more. Also, it's important to remember that some of that is not being paid out potentially right now. Now, there are a few things to keep in mind as we think through all of these different payroll scenarios. Most people, most businesses, hopefully, are not doing payroll manually. I say hopefully because it is shocking how many still do. Payroll software is ubiquitous. It is everywhere and it should be used. There is a reason that we want to have payroll software. They handle the compliance piece of it. But often it is also going to deduct out the payroll taxes that are paid later. And that is all being taken care of. We don't have to worry about cash flowing that later on when the employees have been paid already, but now just the taxes are due later. So often using a payroll software is going to be very helpful in that scenario because it's just handled for them. So what we often want to do is think about every payroll that is run. There are expenses and there are also liabilities. And of course, there is an effect on cash as well. So all of those pieces are going to come into play. It is going to be an equal entry. There's cash, there's liabilities and expenses, which we know rolls into that equity section. So it's all going to balance. We need to make sure that we are helping to educate our clients that everything related to payroll is not on the profit and loss statement, that there are things that could be sitting on the balance sheet related to payroll that they will need to have the cash for later. So for new bookkeepers, understanding that payroll entry is really, really important. The amount that comes out of the bank account is not all payroll tax expense. It's not all just payroll expense. Some of that is liabilities. Really understanding that equation, understanding how it works, when it needs to get paid, anticipating the cash that's required on hand to not only handle the payroll for today, but the payroll taxes for when they are due, whenever that is for tomorrow, or whatever tomorrow date is. All of those things are important, and making sure that the client understands that when payroll happens, they do need to look at the complete picture for that client, for their business, which is the P&L and their balance sheet, understanding all of that, and making sure that they are prepared for what needs to happen, or they're using software that does that stuff for them so that they don't have to worry about it. They take care of it all in one fell swoop.